Good morning, everyone, and thanks very much for joining me. This is the morning market review. My name is Russell Shaw, Senior Market Specialist at FXCM. My email address is rshaw@fxcm.com. And of course, if you need to get in touch with me, just send an email through to that address. I'll respond as soon as I can. Today's Friday, it's the 18th of March 2022. Just bringing up our high risk investment warning. I'll keep this on screen for a few moments. And then I'm going to bring up the commentaries disclaimer. Okay, here's the market commentaries. I'll keep this on screen for a few moments as well. And just finally, here is our references. Market Scope 2.0. I'll read the CNBC.com European article in a moment. And perhaps we'll move on to trading view. Let's just go through to the CNBC article, and the headline reads: European markets set for a mutual open with Ukraine-Russia talks in focus. And it starts off by saying European markets are set for a cautious open on Friday, with investors tracking negotiations between Russia and Ukraine and digesting a big week of central bank decisions. Little progress has been made so far in talks between Russian and Ukrainian diplomats after a fourth day of dialogue, as Russian forces continue to bombard Ukrainian cities. Commodity prices rallied once again as fears of sanctions, Commodity prices rallied once again as fears of tighter sanctions and persistent supply problems re-emerged. US President Joe Biden is set to speak with Chinese President Xi Jinping on Friday, with the two leaders to discuss topics such as Russia's war against Ukraine and competition between the two countries, according to the White House. Shares in Asia Pacific were mixed on Friday, with Hong Kong's Hang Seng Index continuing to exhibit wild volatility amid a rollercoaster week. The Bank of Japan on Friday held its monetary policy steady in a largely expected decision, warning of extremely high uncertainties in light of the situation in Ukraine and its impact on prices. The decision came after the US Federal Reserve on Wednesday approved its first interest rate hike in more than 3 years, and the Bank of England on Thursday hiked rates for the third consecutive meeting. Stateside, US stock futures slipped in early pre-market trading, and that's after a 3-day rally. And this is the largest weekly gains since November 2020. Earnings before the bell on Friday came from Porsche and JD Wetherspoon, while the Russian central bank is set to announce its latest interest rate decision as it attempts to steer the country's economy through a historic barrage of international sanctions. Okay, I don't want to discuss the yield curves, but what we're looking at here is the yield curve. We discussed this yesterday. Except to say that it's still 25 basis points away from completely flattening. So we'll just have to keep an eye on that. Where I do want to start is with the oil price. I brought up UK oil, but we can take a look at US oil. It's exactly the same type of pattern. Okay, we'll just keep it on the Brent proxy for now. So here's the Brent CFD. All right, so let's just understand the sentiment, what's going on in the oil markets, because for me, it's sort of the X factor, right? If it carries on moving down, the odds for stagflation lengthen. If oil moves back up, the odds for stagflation shorten. Okay, so what we're going to do here is combine these two candles. So we'll take the high and the low. So we'll just go here and put it down like that. So we've got the range over the last 2 weeks. And what we'll do is we'll put in the open price, which is this guy over here. So we're just putting out. All right. And where are we in terms of the close? Well, the close is right over there. When I say the close, well, it's still a live candle, so we got to see where it closes at the end of trade today. But right now, as we are combining the candles, it is this price, yeah. All right, and what we'll do is we'll change this bar into a candlestick, which I just think is more familiar to us. And what we'll do is make this a red candle, because there's the open and there's the close, right? So it must be a red closed off body. So, and what we'll do is we'll just change this from this turquoise to a red. Now we got something that looks a little bit more workable. And you can see that if we combine the two candles together, what do we have? We've got one big spinning top. What's a spinning top? It's a candle of uncertainty. So the oil market, if we had to say what's the current sentiment, over the last 2 weeks, we've seen prices being driven up to $133. We've seen price being driven down to $96 or $97. That's a huge range, by the way. Okay, so I mean, we're talking about a $40 range in oil, which is crazy. I mean, look how tiny the candles are relative to the last 3 weeks. There's been a lot of emotional trading in energy. Clearly, this is a result of the Russian invasion of Ukraine. But where does the market stand right now? It's uncertain. It's uncertain because, as we've just read, talks haven't made much progress. There is now renewed uncertainty regarding supply chains. I'm not even certain that we're feeling the sanctions. Well, I know that we're not feeling the sanctions yet. They're going to bite Russia in a big way in the coming weeks. So the idea here is market is uncertain. Now, the big danger with this chart over here is the RSI. You see, when we had the first 2 weeks, the reaction to the first the first, let's say, wave of reaction in the oil markets once the hostilities broke out, it moved to a point where it was overbought. Okay, so that overbought condition is now that's normalized. The overbought condition is gone. So what does that mean for us? It means that there is certainly a prospect for higher prices. By the way, we can go down to the 4-hour chart here and still debate whether this is truly an exhaustion or a runaway gap. I'm not. It looks to me as if it was an exhaustion, but you know, time will tell if it is, because prices seem to be uncertain. That's the takeaway. Uncertain, and if the oil market is uncertain, that's not a good place for us to be on many levels. Certainly as consumers, because we'll be paying higher prices at the pumps. I assume some governments, if they have the capacity, will try to subsidize and absorb some of the higher prices, but they certainly won't be able to absorb all of it. So if this carries on going northeastwards, well, we've got to go through to our gold instrument, and the gold instrument to me is the big sort of stagflation sort of indicator. Is there that stagflation? Isn't there the stagflation? Again, let's combine the last 2 candles, and the range here for gold is huge over the last 2 weeks. We go right from there to there. Okay, what we'll do here is we're going to just change this through to a red. Now, where's the open? Where's the open? So the open's over here. Okay, so let's put the open here. Okay, there's the open. Let's just change it to red. Where's the close? Close is over here. Okay, so there. Again, that close is not the final close because there's still trade this week. We haven't closed trade for a week. And let's just turn this into a candle, and we get this type of a candle here. All right, so we still do have resistance. Clearly, there's more resistance above us than sort of buying tail. So more selling tail than buying tail. However, let's just talk about the sentiment here. Bulls push price up to the high. They subsequently lose control to the bears. Bears push price down to the low. But it's going to be a bit higher, just like that. Okay. And then the bears lose control to the bulls. Bulls have pushed price up. What kind of candle is this? I would posit again, it's a candle of uncertainty. So this is the environment that we still find ourselves in. It's been a theme for 2022 on different sort of on different levels, different themes. The first part of the uncertainty came in sort of in January. The first half of February, we're talking about inflation running through to a 7%, 8% year on year. That was going to lead to tighter monetary policy. We're going to look at the monetary basis starting to actually decline, and that produced some headwinds in the market. And then, of course, we had the terrible invasion of Ukraine by Russia, and that was an injection of mass amounts of uncertainty. And markets don't move in a straight line. They tend to ebb and flow. And so the initial uncertainty perhaps led to some bargain hunting over the last few days. But what I would suggest is caution is still very much the order of the day. We've seen an uncertain candle on gold. And most importantly, I would suggest is we've got an uncertain candle on oil. So, and these are big sort of catalysts for which way we go for the rest of the year. Now, we've already seen the central banks, specifically Fed and Bank of England, raising rates this year. The Fed effectively kicking off its hiking cycle. The Bank of England, as we read, this would be the third increase in a row. Earlier in the week, we took a look at R. So I think let's just bring it up. We won't go into too much detail here, but I still want to keep it very much on the forefront of our mind because it really is what's driving the market at the moment, this weird letter R. Okay, so what does R stand for? It stands for required rate of return. And typically, the higher the risk that is in the market. Now remember, how do we define risk in the market? Easiest way to define it is with uncertainty. If we've got heightened uncertainty, we've got heightened risk. And if there's heightened uncertainty, well then as investors, we want a higher rate of return. If I'm going to risk my cash in an uncertain environment, that's fine as long as you give me a higher rate of return. That's called a risk premium. So with interest rates rising, with geopolitical tensions at on a knife edge, hugely uncertain, our required rates of return are in flux. So maybe it was lower yesterday than the day before, but it's certainly higher today than it was yesterday. So it's in flux. And the problem with R is it's inversely related to prices. So we're just going to go like this. We'll put a 1 over R here. Okay. And we'll put in a equals. We won't put in an equal sign. I'll put in like a little alpha here. How would I do that? I'll write in kind of a little alpha, which I'm going to call is proportional to. So the inverse of R is proportional to the present value of the markets. So in other words, what I'm effectively saying here is if 1 over R is directly proportional to present value, then present value is inversely related to R. It's a sort of an obtuse way of saying that the higher R goes, which is what we're saying that required rate of returns must be increasing because of the uncertain environment, well then there's going to be a pressure on present values because of this correlation here. And that's very important for us to acknowledge. The required rate of return, if we can get this to sort of stop its fluctuation, if we can get some sort of stability, then we can analyze with more confidence. But I think it was Pete who earlier in the month said it's just very difficult to make any sort of inferences now. And why is that? It's because R is in flux. Our R is in flux. Okay, the higher the uncertainty, the higher the required return. Okay, think about any instrument that's got a high volatility. Think about Bitcoin or cryptos. There's a high rate of uncertainty. So as a participant, your R for cryptos is much higher. Everyone's expecting a killing off of cryptos because of the heightened uncertainty there. Okay, so the higher the uncertainty, the higher the required rate of return. Now, what this perhaps suggests is that the level of R may only may suggest that present values still have to adjust downwards before we are confident of getting our R. In other words, we would be willing to invest in assets at a lower price because then there's a higher chance of us reaching our R. So this present value is also in flux, just as R is in flux, and that's the uncertainty. And that is exactly what's been reflected in the technicals. Okay, so that's technicals don't act in isolation; they reflect fundamentals. The fact that we have the flux in the required rate of return, well, you can see that's because of the uncertainty in oil. That's because of the uncertainty in gold. And that brings us now to the DAX. With all this uncertainty, what is the DAX doing? So let's go down to the DAX and let's take a look. I know what it's Howard. I didn't hear your voice at all. So in fact, you don't have to worry. The GoToWebinar automatically mutes. It automatically mutes attendees. So don't worry about that. Howard's also saying my sound keeps disappearing. Can you guys hear me? Just let me know if the sound quality is okay. Let's just take a look at DAX. All right, Anna's saying it's loud and clear. Okay, cool. We'll take a look at the dollar. Absolutely, Anna. Yeah, no worries. Let's just take a look at the DAX. So how does this uncertainty factor into the DAX? All right, so again, we can only make inferences, and the inferences are going to be volatile, I guess, because the uncertainty is there. What we can see here is we do have the lowest low, okay, on our weekly, and you can see that it does look like we are getting the other two conditions, which is price taking out last week's high, and it looks as if we may close above last week's high, and this is a swing low point, so that's positive. That's positive. I think that there could certainly be value here. The question that we've got to try and answer, and again, I don't have the answer for it. The question we've got to answer is at these levels. So we're clearly at we're clearly at lower levels. Okay, at these levels, is price low enough? Now listen to this, because this is the crux. This is what's happening in the market. Okay, is price low enough for market participants to believe that they can achieve their required rate of return? If they believe that they can achieve their required rate of return, then this is a great place to be getting into the market. Okay, however, if market participants doubt that the required rate of return, okay, can be achieved, prices need to fall more, because the lower the price, the easier it is to achieve a required rate of return. Now, if that sounds quite sort of strange, it's pure mathematics. So let's just understand why that is. Okay, so what I'm saying is each of us has a specific required rate of return. The assumption is, so there's a simplifying assumption, is that we're all risk averse investors. That means we require some sort of reward for taking on risk. So I think that assumption is fairly logical. The higher the risk, the greater our reward that we require. Okay, so if we've got a share or a stock that is trading at 10 bucks, okay, and let's just say we require 100% R. Let's just say we require 100% R, and it only moves to 11. Well, that's not going to cut the mustard for us, because that's only a 10% return. So we probably will stay out of the market, because we're not going to get the 100% we require. Now, clearly, I'm talking very hypothetically. Anyone that requires 100% return in the market, you know, you're fishing in the wrong pond. But the idea here is, if this same instrument drops to 1, okay, and it goes through to 2, guess what? We've just hit our 100% return. So in other words, if market participants require R and there is doubt that R can be achieved, prices need to come down. Okay, that's the big deal here. So that's what we've got to ask. Do market participants, are they confident that they're going to get their required rate of return? Now, required rate of returns in flux, because we can put our money into a bank now and we'll get more, okay, this week than we would get last week. All right, so R is in flux. Having said that, we do see this. This is a potential swing low. That's a good sign. However, I want to go through to this over here, and this is how I think we're going to monitor this situation, because as Anna said yesterday, it's very visual, and because it's visual, I think it serves our purpose well. So we're going to go through to our weekly, okay, and the weekly shows a downtrend. In other words, the green below the orange, orange below the red, on a longer term weekly scale. Okay, so we do have a downtrend on the weekly as per our triple moving averages. There is something I must tell you guys, just to be completely transparent. There's gonna, by definition, there has to be a lag with moving averages. So we only gonna know, okay, whether this is a low point in time. We won't know right now. But what we'll do is we'll go down to the daily. The daily shows a different tone. It's more positive. Why is it more positive? Because we're not in a bear trend according to the triple moving averages. We're in a neutral position because the crossover here has taken us out of the bear. In other words, green is not below orange anymore. We've actually got green above orange and orange below red. So we're kind of in a neutral environment here. I would suggest if daily goes through to a bullish type of setup where we've got green on top of orange, orange on top of red, and I would suggest if we go to the weekly and the weekly turns neutral, in other words, green goes above orange, I think that is probably a good base for us to start working on. Okay, the market is now quite comfortable that R is fairly achievable, not guaranteed. Okay, so So that's the point, is that we may have what we call a bear market rally here. And the fact that we have these uncertain charts on oil and gold, to me, heightens the probability that we may have a dead cat bounce here. So we don't want to say, you know, the market has run down so low that we can achieve R. I'm not sure that's the case. In bear markets, it is the bear market rallies that do the damage because they pull us all in. We think that the worst is behind us. We think we're getting a bargain. We go in at first sort of gaze, it looks good, and the next thing, the floor falls out from under us, and we get pushed right down. So we want to be cautious. Anna just asking if we can take a look at the dollar. I think that's a good idea. Let's bring that up. Okay, again, we're looking at the weekly here. We've got a bull pattern according to the triple moving averages. Green on top of orange, orange on top of red. Good angle separation. What's happening on the daily? Okay, so the daily got a pullback, but this is still a bull trend. Green on top of red, sorry, green on top of orange, orange on top of red, I beg your pardon. And what we can take a look at here is the pulse. 1, 2, so here's the heartbeat, right? 2, 3. 1, 2, 2, 3. Okay, so now what we're looking for is the higher trough. Okay, I'm going to put a question mark here because we don't have the high trough in it. If it carries on falling, it's no good. But the idea is, if it takes at this point here and closes above that, then we've probably got a higher trough locked in, and we may get some more upside. I, at the moment, would expect dollar support, by the way, because of the aggressiveness of the Fed. Okay, so these pullbacks to me is something that we need to watch because it could be the buy the dip type of scenario. So we want to just be very, very cognizant of that. And just to be transparent with you guys, okay, I do have a short. I do have a short on the euro, just a small short, because I think that this may be a bear market rally. I've got to stop in, so if it goes against me, it goes against me, but it will be stopped out. But the point is, I think that there is dollar strength to come. So I have taken a position. It's not a buy or sell recommendation. I don't know if it is going to work out that way. That's why I've got the stop loss in. But I'm quite sort of I'm quite comfortable to put in that position and accept the loss if it goes against me. All right. Let me just see if I've missed any questions. All right. If there's any questions, guys, go ahead and type those in. All right, nothing coming. I think what we'll do is we'll conclude at this point. Monday is a public holiday, so we won't have a webinar on Monday, but we'll be back Tuesday. Thank you. This is the, yeah, so you earn interest overnight. Exactly. So so it won't be exactly at the overnight rate, and I mean there would be sort of markups done on our side and markups done on our sort of liquidity provider side. But what you would do is you would just bring up this this chart here, and here's your rollover, right? So you just take a look at the rollover for the euro US dollar, and you can see the rollover here is positive for shorts, negative for longs. Okay, but yeah, you would earn interest there, and remember you're earning that on a margin position. But don't go for the interest. Don't over leverage yourself, because then the capital will the capital movements will margin call you. All right. Thanks very much. Is there anything else here? Nope, that's all good. All right, guys, let's sign off there and chat to you guys on Tuesday. Have a terrific weekend and speak to you then. Cheers.